Hi. Off late, there has been a lot of discussion around the world regarding the rising bond yield in the US and the investor community, especially with the equity asset class. It really has got people terrorized across the world. Some are actually debating whether we are actually heading towards an impending crash or there is going to be some bit of a correction before the trajectory continues. And amidst the bull run that we all are in, there's a serious question which is now being faced by all investors. Are we actually in one of the greatest financial bubbles of all time? So, what I see is that many pundits and many experts across all the news channels and the social media have come across and presented their views. Some of the views are, siding by the bull market. Some of the view are talking about taking a rather pessimistic view. What I did was that I thought that it was actually the time to take a holistic look, a holistic and yet a deep insight into the whole matter. And from my point, then I've tried my level best to actually come out with some evidential facts, which I believe will actually help the investors at large. Now, this video is not only directed towards the Indian audience, though the examples that I'll be quoting out here mostly will be from India, but this is equally applicable to viewers across the world, whether you're from an emerging economy or a frontier economy or even the developed world. All right. So, before I start explaining the intricate concepts and the relationship, the exact relationship between the rising bond yield with the other asset classes like that of equity or commodity or even real estate, let's first get into some of the aspects. And I seek pardon beforehand because this video is going to be a little bit of technical, but I believe that understanding is required. However, from my point of view, I'll try to explain it in the most lucid language possible. So please and kindly bear with me. The only thing that I can promise you out of this is that you're going to get a definitive answer to all your queries. And depending upon what is your risk appetite, you may then take an informed decision whether you want to remain with the bull run that we all are in, or you believe that it's time to book profit and look for other greener pastures. Okay, so without much ado now, let's begin. All right. So, as we all know, the long-term average growth is always going to be on the upside. So, which means that over a period of time, our economy is going to grow. In absolute terms, definitely that is what it is going to be like. However, along the way, things actually really don't quite move in a straight line. You see the areas out here. So, we will get to these areas more often than not, wherein, there is going to be substantial peak, and then there is going to be trough, which means that from the trough to peak, there are going to be expansionary cycle, and from peak to trough, there is going to be a contractionary cycle. Now, what does this mean? All that it means is that when we are in expansion, this is basically we are in good times. When we are in contraction, this is basically where we are in bad times. All right. So what this particular line that it talks about? Well, this line is you're nothing but the projected GDP forecast, and that's how an economy is measured across the world. So over a long period of time, economy is only going to go up. That's no rocket science for us to believe. But along the way, we will actually never move along the straight line. The straight line is nothing but a complex average of different forecasting tools. So we will be having this periodic ups and periodic downs. That's quite natural. All right. So what happens? So we call them the business cycle. So what happens across the business cycle when we move along with them? Well, when we actually move along the expansion mode, the expansion mode obviously will be preceded by a recession. So when we're moving from recession to an expansion mode, the actual output of the GDP is going to be more than that of the projected ones. Is it good? Well, up to a certain extent, definitely it is. It's like, you expected in your exam that you are going to score only 75 out of 100 and you actually ended up scoring 85. So this 85, well, is a positive surprise for you, right? So the economy, again, is no different. When everything is good, you're going to experience full employment. Asset prices will be up. People's general disposable income will be up. Economy will be doing good, and everything else is good, right? The economy is strong. In the real terms means the currency and the forex will also be strong, and that's how it is going to be. But then there comes The bad times is the contractionary cycle. The contractionary cycle is characterized by unemployment. And unemployment would mean also that there is not going to be any further capacity addition to the business, and normally, generally, the economy is heading towards a contraction cycle. So we call them the recession. So in normal course of time, in normal trajectory, this is bound to happen. No economy can actually move in a straight line, right? If it were that easy, well, you and me, we would have all be super rich. We would have been like that, right? But that's not the case. So in normal course of time, this is absolutely fine. There's nothing wrong about it. Where it becomes wrong is that when you have these, you see this peak, when you have this peak, something like this, which is that over exaggerated peak, right? Over exaggerated peak, or the straw at further than what it could actually sustain. Then when what happens is that if it's stretched beyond a certain limit, either on the upside or on the downside, that kind of distorts this straight line, this long run average, which is also the long run mean trajectory of the economic growth path. It disturbs this particular straight line, and that's not good, right? So we'll get to that a little later. Let's also take what happens. What are the different phases of recovery? So initially, when you're coming out of a recession, we talked about recession. So what happens is that there are basically 4 stages to it. So stage number 1 is recovery. Stage number 2 is upswing. Upswing is further divided into early upswing and the late upswing. And then you have a slowdown. Slowdown will again lead to recession. Now, there are no fixed timelines, which means a recovery process could take from 3 months to 6 months, even a year or 2, or even more. The upswing can last it's only 6 months, or it can last up to 6 years. A slowdown may be only for 2 years, or it could be only be for 6 months, or it could be a decade-long recession like that in Japan as well. And recession is something we know that it's not good for economy in the long run. Well, every government has a positive bias towards a recession, which means that they would want, or rather, they have negative bias, so they take positive actions. The positive actions over a period of time at times can end up in being positive bias. All right, so these are just different things. Now let's see what happens. What are the stages? And these stages, what are the main characteristics? Now, please understand these are pure economic theories, okay? All right, so during the recovery stage, there's a large output gap. What do we mean by large output gap? It means that what did you project as part of the economic growth? You remember that straight line? And the actual output, well, the actual output is less than, this is the projected one, and the actual output, the actual GDP is going to be less than the projected economic growth. So this gap is called the output gap. If this gap is something small, well, that can be corrected and it can be healthy also at some point. But if this gap actually is very large, then there has to be certain measures that ought to be taken. All right, so what are the other characteristics? So we have the large output gap. Government provides stimulus. We'll come to that a little later. Bottoming bond yields, low interest rate, low inflation, high employment with large capacity underutilized, but we have better performing cyclical stocks. Now, let's go back to the previous slide for a second before I come back to this slide. Now, as I was explaining that, in normal course of time, in normal course of growth, you'd encounter these periods of peaks and troughs. That's absolutely normal. There's nothing got to do. We don't really have to worry about it. Okay. But when situations actually go out of control, that's the time when there is a requirement of something called as the external intervention. So the external intervention, what we mean by external intervention, the same thing, the government stimulus, the government sucking out liquidity off the market. So this is something which is a little out of the ordinary, out of the turn. So when the economy, when it has actually derailed either on the plus side or on the minus side, we talked about this. So see this particular thing that, the gap when it is more than what could have been anticipated on the plus side or even on the minus side. So to bring that back to the regular course of things, the government has to intervene. And that's economic action. That's econometrics action. And we will try and understand this first, because this is intricately tied up with the asset prices and forms the very basis and foundation of the bond yields that we are going to discuss at large. All right. So in recovery phase, everything is down. The economy is struggling. It's just come out of the recession. It's like, seeing the dawn after a long, cold, hard night. And now it is in the hands of the government, along with the private sector as well, to do something good. And to do something good, what do you have to do? The government has to put back the economy into track. So it does something called as stimulus, right? So they do some stimulating activities. While the capacity is high, the unemployment is high. So the rate of interest is typically engineered to be low. And mind the word engineered. It's not the normal course of things, but engineered. Okay, so that's how things are. Okay, so what is the next stage? So the next stage is that of the upswing. Upswing is what? Upswing is now that the momentum has actually caught up and the economy is now gradually moving towards full swing. It's now, it's pacing up. It may last for more years, and the returns, the business community as such has now a renewed interest. Confidence level is rising, and along with confidence level rising, the bond yields also rise. We'll come back to this bond yield part a little later on, but let's first understand this. So we are basically talking about, if you take the diagram, so this was the recovery phase. This is the upswing phase. So what happens in this upswings? The asset prices will go up. Okay, the asset prices will go up. The bond yields, they will also grow up. The short-term interest rates, that will also rise, but not rise much. It will rise a little bit. Inflation will, well, it still be under control, but at the later half of this upswing, which is in the late upswing part, the inflation will rise faster. Okay, and second important thing is, remember that we talked about that output gap, this output gap we talked about, which was pretty high to begin with. This output gap will now start to close in. Okay, and the central bank will initiate certain action in order to see that things again don't derail on the other side. So in normal course of thing, what would happen, that once it has experienced this upswing, or whether it's the early and the late upswing, the third stage comes in, which is the slowdown. And the slowdown is what? The asset prices, the real prices of the asset will come down. The short-term interest rates and the inflation, they will rise, they will rise high. And business community and the investment spectrum itself will start losing interest gradually, but most surely. They will start losing confidence as well, and the bond yields will shoot through the roof like a Greek phenomena. Remember the Greek bonds, when they were actually yielding something close to at 25%, something similar to that is going to happen. Slowdown is the penultimate stage to the recession, and recession is something wherein everything again goes down. The recession is something where the business confidence is now at its bottom. The bond yield is at its highest. The inflation was highest in slowdown phase. Now it is taken off. It's cooling off a little. Unemployment and bankruptcies are again back. And now thus the cycle continues. So the cycle we talked about, this recovery to recession, this cycle again repeats itself. So that's how it happens. Generally, in general, nobody really can say that how much time it actually takes for one cycle to actually complete. But normally speaking, this whole cycle of recovery to recession, back to recovery, may last anywhere between 5 to 15 years. Okay, this is the total timeline for one particular cycle, and the cycle keeps on repeating. All right, so now that we have understood these 4 important stages of economy, let's move to something summarization sheet. So what is recession? Well, recession is nothing but when the income falls, the real income falls. The real income falls would mean that the disposable income will be less. The disposable income will be less would mean that people will consume less. People consuming less would mean that companies will be experiencing fall in their top line. Fall in their top line will necessitate lesser production. Lesser production obviously will mean shutting down of capacity, laying off people, not venturing into new projects, shelving of those new projects, and that would mean the growth rate of employment is going to fall, employment will fall, and hence employment falling would mean the income again will fall. So this is a vicious cycle. Okay, what is recovery? Well, in recovery, exactly the opposite thing happens. The incomes rise. When the incomes rise, people will have more disposable at their discretion, more money, more funds at their disposal, and hence they're going to buy things which they had actually postponed they had actually postponed. So that luxury car or the second house, the beach house that they were planning to, or the expensive vacation, well, they're going to now have those things. So that would motivate the companies to raise their production. To raise their production would mean to add in capacity, to add in new investments, to add in new ventures. A new hotel is going to perhaps come up, or a new resort is going to come up. That will generate employment to the local people, and hence it will again boost the economy in terms of their livelihood. So this is the whole cycle. This is called the virtuous cycle. Now, as I have mentioned before, that in normal course of things, these things will happen on its own. We don't have to interfere. It's only when that trajectory that I showed you, that trajectory is disturbed. It goes beyond the reach of what it should be, and threatens to derail the whole thing altogether, and threatens to upstage the long-term growth trajectory. That is when the government or somebody has to intervene. Not a divine intervention, but an external intervention nonetheless. All right. So now that we know that there is something called as external intervention rather. So we need to know who are the actors to it. So primarily, these external intervention are actuated by two entities. Which are those two entities? A, the sovereign government, and B, the central bank. All right. And how do they do it? Well, they have primarily two economic tools at their hands. What are those two economic tools? One is called the fiscal policy and another is called the monetary policy. So I'm not going to get into much details of them, but suffice to say, if you understand this particular slide, you would have understood the very basis and foundation of it. And that's sufficient as far as our subject matter out here is concerned. All right. So how many types of fiscal policies are there? Well, there are going to be two types of fiscal policies: expansionary fiscal policy, which is actuated when you have to come out of that recession, go towards the initial recovery and move up. That's when the government has to intervene and initiate something called as the expansionary fiscal policy. The same thing when actuated by the central bank of the sovereign, that is called the expansionary monetary policy. And the reverse of that is when the economy is overheated. Remember, we talked about that output gap. When the output gap is much beyond, the actual GDP has overthrown than what it was projected and gone much beyond that. So that's when cooling off has to come in, and the government in that case would intervene with something called as the contractionary or restrictive fiscal policy, while the central bank will come in as initiating the contractionary or restrictive monetary policy. Now keep in mind that to boost to stabilize the economy, both this or one of them can come and work in conjunction with another one. So that is to say that you can have either embark on the path of fiscal policy, or you can embark on the path of monetary policy, or you can actually do both at the same time. So let's see what happens. So what is meant by expansionary fiscal policy, which is relevant to our current situation? Well, in expansionary fiscal policy, the government's aim is to render the citizen of the country with maximum liquid fund at their disposal. So how do they do it? They have again primarily two tools to do it. A, they are going to lower the tax rate. So if a sovereign was actually taxing you at, let's say, 33%, so the government may propose, well, people don't need to part 33% of their income with me. What they should be doing is, in this tough time, is instead they should only be paying me 20 or 25%. All right. So this is one. What will happen? Two things will happen. First, if the disposable income earlier, which was, if you deduct 100 minus 33, it was only 67. This disposable income has now risen from 67 to 80, or at least to 75, going by the example that I just quoted. So when you have this extra disposable income at your hand from 67 to either 80 or 75, this extra income, the citizens are then going to spend in instead of saving, they're going to spend. Okay, that's the expectation. So they're going to spend where? They're going to spend into, again, the same thing that we talked about. It could be ranging from daily essentials to luxury goods to needs or whatever. So generally what happens is that, again, the same cycle would follow, because now this extra income which is there, which the government has foregone, is now going to the pocket of the corporates. On the other hand, the corporates, since their tax rates is also going to be slashed from whatever it was, from say 25% corporate tax to now it is 18%. That means that they get to keep most part of their profit, right? So they will also be motivated. So it's a win-win situation, right? So one hand you have the consumer who has more disposable income at their hand, and the other hand they have the producer, which again has more profit. So what happens is that both are in a win-win situation. So the producer surplus and the consumer surplus is going to then coincide and work in tandem. Well, it's good. Is it good? Of course it is good, because the only person who is not taking his cut is the government. The government is letting go of that. Why it is doing so? Again, remember, that's an external intervention meant to boost the economy. Okay, so this is rule number one, slashing the tax base. Another thing that happens when you actually slash the tax base, slash the tax rate, more people can actually be brought under the tax net altogether. So it has happened historically. So what happens is that the government may slash the tax rate from 33% to 25%, but earlier, if there were 100 people who were paying taxes, because of the low tax rates now, maybe, just maybe, 120 people are going to pay taxes. So seen from this angle, it's a win-win-win situation for the producer, for the consumer, as well as the sovereign. Okay, so this is roughly, fundamentally, what an expansionary fiscal policy is supposed to be doing. All right. The other tool through which the government can do the same thing is by increasing spends. So how do they increase spends? Well, they build certain infrastructure, because the job of government is not to be in the business, but to be in governance. So in order to do so, the government may actually build a new bridge, or lay a new rail tracks, okay, or open a new fast corridor, the highway, okay, high-speed highway. All right, so how it is going to help the economy? Again, in two ways. One is that if the government embarks upon these kind of spends, they would need people to build this highway, to build this bridge, so which means that it is going to directly generate employment, and the same cycle will follow. Second is that, let's talk about a factory, okay? So if this factory was, suppose, in a remote place where the roads were not that pliable, and it faced considerable difficulty in transporting its goods, the logistical challenges will now be eased because of the new improved road conditions. The new improved road conditions being there, this company is going to be motivated to do more business. How? Because not only the transport is going to be easier, but supposedly because of the good roads, it is also going to be faster. So it's going to be, which means that it's going to be fast time to markets. The gestation period will be less. Gestation period less would mean that the company will have to carry lesser days of inventory, and hence a general improvement in its working capital, and so on and so forth. I just gave an off the bat example. All right. So this is what expansionary fiscal policy is supposed to do. So you need to remember just two things. Government can do this by either lowering the tax or by increasing the spends, or both. In either of these cases, it's going to only benefit the consumer, the producer, and to some extent even the government. All right, so let's go to the next tool. So this next tool is something called as the expansionary monetary policy. This is actuated by the central bank of the sovereign. All right. Now, what we are experiencing and witnessing right now across the world is the act of the Fed. Fed is the central bank of America. So what Fed is now embarked upon the journey is an expansionary monetary policy. How do we know that? Well, the tools are very similar. How does an expansionary monetary policy work? Well, it's nothing but more than an interest rate function. What is meant by interest rate function? Basically, lower the interest rates. So if you lower the interest rates, what happens? If you lower the interest rates, the borrowing power and the borrowing capacity of the corporates as well as the consumer will increase. Since the cost of inputs has now come down, it will again motivate both the consumer as well as the producer. All right, so it's no-brainer actually. So let's see how they did do it. So now that we know that it's going to be an only interest rate function that the central bank does, how does it do it? All right, so the way it does is that it infuses liquidity into the system in addition to lowering the interest rates. So how do they do it? Well, the supposedly Fed has its own funds, own reserves. So it can actually bank upon its reserve, right? And from this reserve, they can distribute money as part of the stimulus package to its citizens' bank account, right? That it can do. All right, but if it does so, there is a problem. And this problem is that not only the reserves will be depleted, but because the US Reserve, the Fed Reserve, is also harboring a fiat currency like that of the US dollar, which is an asset as far as international currency and exchange is concerned. Hence, if it does not have sufficient amount of dollar here, and God forbid if tomorrow there is a war-like situation, then there is going to be certain liquidity pressure on the Reserve Bank, the central bank of US, right? So ideally, this goes out of the window. Even if you have reserve, well, you should not only be expending or distributing it from your coffer. The second way of doing is something called as the open market operation. So what is the open market operation? Well, it's nothing. What the government does is the government buys the bond from the open market. All right, they buy in the bond from the open market, and when you buy the bond from the open market, the money then goes in the hands of the bond issuer or the bondholder, or the previous bondholders. So it could be again corporates, it could be again retail investors, it could be again institutional investors. I don't know. But what the government does is that government is saying, then you take this money, give me the bond. You take this money, give me the bond. So what has happened? Again, there is a surplus liquidity in both the hands of the producer as well as the consumer. All right. So now, what has happened? A couple of things have happened through this expansionary monetary policy. One, there is a liquidity plush in the hands of both the consumer and the producer. Second, the borrowing cost, the real borrowing cost has come down significantly, thereby incentivizing the consumer as well as the producer to borrow and spend more. Okay, that's the whole idea. Again, what it is going to do? Again, it is going to actuate that cycle. Remember the Newton's first law of motion. Every object is supposed to be in its state of physicality until and unless it is prompted by an external force. So this actions by the central government as well as the sovereign is nothing but those external forces in order to put the economy back into momentum. I think it should be amply and crystal clear, right? So we summarize the monetary policy. So monetary policy is nothing but an interest rate function wherein the central government deliberately lowers the interest rate. That is the expansionary monetary policy we are talking about. Deliberately lowers the interest rate so that the cost of input as well as the cost of borrowing comes down. And secondly, it buys bond from the open market via an open market operations, and thereby funds the consumer as well as the producer with much awaited or much required liquidity in the hope that the economy is going to come back to the trail, come back to the track, because consumers is going to, with the renewed capacity that they have, they're empowered now and they are going to buy more and they're going to consume more, right? So this is the whole agenda. Great. So there's going to be an increase in aggregate demand. Increase in money supply would mean decrease in interest rate, increase in investment, and increase in aggregate demand. All right. So this is nothing but the whole idea of what we talked about. And so as I say that in the expansionary policy can either be a monetary or a fiscal or a combination of both, right? So this is the cycle whole of it. I'm not going to spend much time on it because this is something which I have been explaining all along. So it's going to be a repetition of sort. All right. But when you keep on doing this, you keep on actually, stimulating the economy by initiating stimulus packages of 1.9 trillion thrice, ultimately it will lead to higher inflation. It might actually support your economic growth for some time, but because of the higher inflation, the domestic currency is
potentially stands to be devalued. And in the short term, of course, the employment generation is there. Now, so far we talked about the expansionary policy, both the fiscal and the monetary. What happens when the economy overheats? When the economy overheats, we talked about implementing the tight, restrictive or contractionary policy. It is exactly, the actions are going to be exactly opposite of what has happened in the hands of government as well as the central bank. All right. So some terms for use. We talked about real interest rates. We talked about what is meant by term structure, nominal interest rate, constant income hypothesis, and Taylor's approximation. Again, I seek your pardon. This is not what I intended to do, but the issue at our hand is so complicated, and I believe that it's beyond the reach of common people. Explaining bond yield in any other way, rather than to take them through the ABC's foundations in the most easy manner possible. And I think that if you have been attentive so far, it would not have been that difficult to understand. All right. So the real interest rate, let me dive directly to what is meant by nominal interest rate. Well, frankly, what nominal interest rate means is real interest rate plus the inflation. All right. What do we mean by real interest rate and inflation? All right. Okay. So the real interest rate, remember we talked about that borrowing rates being lowered. When borrowing rate, okay. So first and foremost, let's understand what we mean by nominal interest rates. Well, nominal interest rate is something by means of which you and me, we transact, even the corporate transact. So that's the nominal interest rate. When you borrow from the bank at the rate of 2%, so this 2% is the nominal interest rate. This nominal interest rate in turn will have two components. One is the real interest rates and another is the inflation. So please understand, roughly speaking, the risk-free interest rates or the real interest rate plus the inflation will make up this 2% under consideration. So we can only deal in nominal interest rate, not the real interest rates. All right. So what is the significance of it? The significance of it, this is, if your asset prices will go up, as we have talked about along the economic cycle, the real interest rates will also go up. Real interest rate going up is a good sign. Real interest rate going up is a good sign. Why it is a good sign? Well, in that case, everybody's happy. Everybody's happy. It means that you were consuming something and you're paying $100. Now you're paying $120 because the perceived value of the consumption is more than what you had seen before. So maybe, for example, you had bought your Apple iPhone for, let's say, $1,000. Now the new Apple iPhone has come in the market and it's priced, obviously going to be priced more than the existing one, and it's priced at $1,100, 10% more. But you don't flinch an eyelid, right? You simply go and back it up by paying another $100. So you don't mind paying 100 additional bucks and have that iPhone in your pocket. Why? Because you perceive that you've got a superior thing than what you had already. Okay? So in this case, this 100 addition to the 1,000 of the previous iPhone is fully justified. That's real interest rates. That's real interest rate. So real interest rate going up is really not much of a concern. The concern is that we as general consumers and producers, we will not know, or the bank or the lender will never tell us that if my borrowing rate is 5%, how much of that is real interest and how much of that is inflation. Of course, we can find it out. But in general, they're not going to tell me that, right? All right. So in this situation, if the real interest rate is going up, that means it's a good thing. But since we are dealing with nominal interest rate, we must know if in part of the nominal interest rate, which part is going up. So let's say our nominal interest rate was 4%, which means the rate at which we can borrow. Now the nominal interest rate has become 6%. So this is a massive 200 basis point increase. Now, if this 6%, if this 4% was 2% real interest rate and 2% inflation, and now this 6% is 4% real interest rate plus this 2% inflation. So see what has happened. Inflation has remained same. The real interest rate has jumped from 2% to 4%, which means that people are valuing the goods in their hands. Okay? This is absolutely fine. There's nothing wrong. But if this 6% is wherein this 2% real interest rate, but now the inflation has climbed to 4%, thus making it 6%, this is bad. This is bad. So this is something that we need to understand. All right. Next is constant or permanent income hypothesis. What it means? Well, constant or permanent income hypothesis, what it says is that the change in a person's or a household income, okay, is directly proportional to the spends. Okay, so which means that in good times, if a household income is, let's say, 170K, in good times, if there is an increment of 10%, so which means it will go to 187. So this extra 17K USD in good times, the household wouldn't mind spending because their retirement savings are already being taken care of through their base income, right? They won't see much of an incentive in saving further. Of course, it's a general statement to be made. This extra 17K could be spent in that vacation, in that holiday home, or buying that new car. Okay, this is what is called as the constant income hypothesis. The last but not the least of this is something called the Taylor's approximation. Let me not make it any further explanatory because it's a little bit of technical. All that you need to know that Taylor's approximation is nothing but this is a tool in the hands of the Reserve Bank, the central bank of the sovereign, which can govern the nominal interest rate in such a way that it may mitigate the threat of inflation or the overheating or overcontraction of the economy. So, okay, so what it does is that it has three components to it. One is called a long run real interest rate, and then another thing is the output gap, and another thing is the difference between actual inflation and the projected inflation. Okay, so it balances through these three factors in order to come out to a rate which will mitigate the effects of inflation or deflation, as the case may be. Okay, all right. Okay, so our technicality, the economics part of our session is now complete. Let's move to something called as bond. So as far as bond is concerned, let me first tell you that it's not very exciting because we don't get to hear bond every day without knowing the fact that the bond market all put together is the largest asset class in whole wide world. It is close to 70 times as big as that of the worldwide equity markets. The commodity market, on the other hand, is about 20 to 30 times the world equity market. This twice $1.9 trillion, one in the phase of Donald Trump, the ex-president, now the present president, Joe Biden has signed in the second stimulus package, and the Congress is again they're contemplating for the third stimulus package, and so on and so forth. Well, how does that happen? The mechanism of that is open market operations of bond buying and bond selling, which I had already explained. All right. Okay. So let's understand what is bond in the simplest term possible. So let's say you have to. All right. So bond in the layman's language is nothing more than a fixed deposit. Hold on. I'm getting to that. So what we mean by fixed deposit is that I have, let's say, 100,000 USD with me, and I deposit this in some money market instrument or with a bank, which, let's say, tells me that it is going to pay me at the rate of 5% per annum every year. But there is a catch to it. The catch is that I cannot withdraw this money for the next 5 years. Okay? All right? If I do withdraw, there is going to be certain penalty. I'm just making out this example in order to elucidate what bond is all about. All right? All right. So what happens that in the first year, you have invested here, the 0th year. In the first year, you earn this 5%, and this 100,000 becomes 105,000, right? In the second year, this 105,000 would become, let me quickly calculate, this will become 110.12 110.25 thousand USD. Why this 110.25 thousand? Because now this 5% is going to be applicable to the new principal of 105. Okay, so this becomes 110.25. Okay, so by the time you reach 5 year, you reach the fifth year. Okay, so your actual yield on the investment of 100,000 USD has now become 127,000 USD. Okay, 127,000 USD. Okay, a bond almost works as similar to this. Okay, a bond almost works as similar to this. The only catch is that, so what happened was, so if you just look into it, what happened was that you invested 100K and you got 127.7K at the end of 5 years. Okay, that's what you got. All right, good. Now I have to let's improvise upon this problem a little bit. Let's imagine a scenario that you require some money out of this. Okay, you require some money out of this, but you cannot withdraw. If you withdraw the money, then there is going to be a penalty which is going to be imposed. Now, you know that at the end of the tenure, you're going to get your money, plus you're going to get certain principals out of it. All that is very fine. All that is very good. However, a couple of things we talked about. First is that if you require, in this 5 period, if you require a liquidity thing, then you actually do not get to encash this, right? If you require the liquid funds, for some reason, you will not be able to encash without having to pay the penalty. And the second thing is there a risk factor involved? I know most of you will be saying, no, there is no risk factor because you have parked your money with the bank, then the bank defaulting, you're going to get your principal plus the accrued interest and the accumulated interest overall. So it's good to swell. It's a great thing. Well, technically, it's not so. For example, you were promised an interest rate of 5%. Now, let's say 2 years down the line, there is another investment avenue which promises you 7%. And it has the same riskometer. It is as safe or as risky as the investment in bank was. So what has happened is that you practically would be losing 2%, right? You'd be practically losing 2% for the next 3 years, right? All right. So which means that there is a risk factor associated not only with my principal, which is measured by the credit quality of the bank itself, what is the credibility of the bank, but I am also risking my interest income by parking my FD, because 2 years down the line, I have an investment opportunity which carries the same amount of risk, yet it is giving me 7%. All right. Let's take one more example. It could also happen that 2 years down the line, your 5% is the best investment possible in the market, because by that time the market has taken a downturn and the other investment avenues in the fixed income market, in the bond market, is promising only 4%, right? So both these things can happen. Nonetheless, the risk still remains. All right. So if the risk remains, there has to be some measurement, there has to be some way to find out this risk. How do you find out that risk? Well, there could be 10,000, a million factors which may actually govern the risk of the valuation risks of the different asset classes, whether it's equity, whether it's commodity, or the fixed income. Okay, as far as the fixed income is concerned, or even in case of equity, it's not practically possible to list down all of those factors, because these factors keep on changing. They're not constant throughout the time, and neither their impact on the asset class or the asset valuation, right? So their impact can also vary. So you have the number of factors that can vary. As part of the risk factors, you would have the impact also of those risk factors, which can vary through time. So when you are faced with this situation, you need to boil down to a single factor. So in case of market and equity market, you would have heard of a term called as beta. Well, beta is nothing. What it does is that it measures the movement of the equity stock prices with respect to that of the broader index. In case of bond, that is measured through a tool called as duration, but let me not get into that. Suffice to say that the entire riskiness of the bond is actually embedded into a market interest rates, because we just talked about, right? Other than the credibility of the bank defaulting, this is the only risk that you're facing, or this is the way you can only measure the risk. If the market interest rate, if you have a better investment opportunity, or you have a lower investment opportunity across the horizon of your investment, that's how you'll measure. So this interest rate is called the yield of a bond. Okay, this interest rate is called the yield of a bond. Now, for all practical purposes, for all practical purposes, what we do is that we take out the treasury interest rates as the measure of yield, or at least we base our calculation on the treasury interest rates. So depending upon the horizon of your investments, your investment could be of 5 years, it could be of 10 years, or it could be of 20, 30 as years. So those interest rates are going to be important in order to list down what is my yield. Okay, but natural that if you have a tenor of bond which is only lasting 10 years, between another 20 years, another 30 years, so it is but obvious, all other thing remaining constant, the greatest risk is embedded in the 30-year bond. Why? Because it calls in for something called as uncertainty. The degree of uncertainty increases as the time horizon increases, which means that you would want more yield for a longer tenure. Similarly, if you're actually dealing with the short end of the yield curve, you would want smaller yield. You'll be satisfied with smaller yield because your uncertainty is limited only up to 10 years. So longer the maturity tenure, longer is the yield. All other things remaining constant. So yield is nothing but the market interest rates. Okay. Now we talked about market interest rates. So what is the best tool as far as market interest rates concerned? Nothing but the treasury security, right? Because they're risk free, they cannot default. If you have to take a reference, this is the best reference points, right? Or the G6. All right. Now, most of these treasury securities or G6 come into the market as couponless or zero coupon bond, which means that you park, let's say, $1,000 here and you hold on to this for 5 years. You're not going to accumulate, you're not going to get your 5% return every year, but you're going to have this 5% rate of return accumulated and you will be given a lump sum at the end of 5 years. Okay, that's how, not to say that there are not coupon bonds as far as the T6 or the G6 are concerned, but what is important is the majority of them are made out of this lump sum kind of thing. So they are called the zero coupon bond. So which means that you're definitely not going to buy a bond today which is costing you 1,000 rupees and you're going to get only 900 rupees at the end of the tenure, right? You're not going to buy that. You would rather buy a bond today which is giving you 800 rupees, which will promise you 1,000 rupees at the end of the tenure, right? So this is the function of the zero coupon security. This is the function of the zero coupon security. And since we talked about the treasury security, all of them or most of this treasury security that we are talking about, they are couponless. They're completely couponless. So at the rate at which this 06 securities are actually selling in the market actually then determines the yield. For example, if suppose, because what you're going to get at the end of the tenure is already known, it's already fixed. You're going to get the face value which is capped at 1,000. So if you're buying today, let's say at $850 for a 2-year period, okay, so can you calculate the yield? Well, yes, of course you can. There's a formula and that formula is pretty simple. There you go. So if you can solve this math, then that becomes your yield. and this is somewhere around 8.4%. So this bond is yielding 8.4%.
All right. So if the bond is at 750, but natural that it's yielding more. But look at what is happening. As you go on decreasing the price, the current price of the bond in the market, the yield goes up, right? So I think from here it is suffice to say, because the redemption amount of 1,000 is already known beforehand, right? That's also called the par value or the face value. So which means that as the yield goes up, the current price of the bond must come down and vice versa, right? Or in other words, you're going to get certain cheap bond today and you're going to get 1,000 at the end of the tenure. So if you, all the more better, if you're getting this bond at 700, 2 years down the line, you're going to get 1,000. That means you've got more yield. But look at it from the perspective of already the one who is already holding the bond in his hand. From his perspective, it's not that great thing because he must have bought this bond at somewhere around $900 or let's say $800, and he has to settle this bond in the market today at $700. Okay, it might benefit the one who might be purchasing from him, but not him per se. Now comes the second part of it, and that is the bond market is liquid, but they're definitely not as liquid as that of the equity market. And most of the bond markets are being, most of the bonds that people actually invest into, they invest into with the perspective of holding them over the horizon, okay, or use them as some sort of investment guarantee, okay. That's how the banks function between themselves, all right. So which means that the secondary market thing actually goes out of the window. Not that it's not tradable. It is tradable. It's common security. It's 100% liquid. But the homogeneity of this market is that most of the bonds are actually held into horizon. Okay. So which means that the bond that I purchased today at 800, the yield going up today is valued only at 700. I know it for a fact that I have to deal with this and my valuation is coming down. Is it good for me? It's not good for me. Maybe somebody who purchases it from me, he might benefit out of it, all right, but not me, okay. All right, now let's boil down to some of the facts now. And the fact is that when the Fed, through its open market operations, started purchasing the bonds, okay, and it plushed the consumer and the producers alike with liquid money, cheap money. What also happens, couple of things happens. One is that, of course, the consumer had much money, much disposable income in their hand. The producer, on the other hand, had cheap money that would actually boost their production, that would actually lower the cost of input, and hence it will help them. All right, that's a great thing to have happened. However, there's a caveat to this whole thing, and the caveat to this whole thing is that in course of actually providing the much needed liquidity, the Fed went on to an ambitious program of buying some corporate bonds also, which were below investment grade, which are also called the junk bonds. So what means that you would have those mom and pop shops, kind of a small scale companies, which may have limited history or limited heritage and lineage, yet they managed to secure a cheap funding. And since cheap funding was there all along, so they were flush with liquidity. All right. So this is what happened at the corporate end. Does that carry risk? Of course, that carries risk, because now the Fed indirectly has not pumped in money only in the grade A corporate, but effectively it has also pumped into money into those BB minus rated companies as well, which carries substantial risk, and the C category companies as well, which are practically very near to default. Now, if there is an economic collapse anywhere, these will be the first to topple over. Their heads will be rolled first. Okay? And who is going to lose? The Fed is going to lose. But hey, wait, the story doesn't end here. What happened this is as far as the corporates are concerned. What happened to the general public? What happened to the consumer? Well, now a couple of things happened. During the lockdown, most of the consumers, some of the consumers, just a sec. All right, yeah. So during the lockdown, the pandemic era, about a year back, the the extra liquidity that was there in the hands of the consumer, they needed to spend somewhere, right? Where would they spend? Because there was lockdown, right? There was lockdown everywhere, which means that even though people lost their jobs, with the added stimulant in their hand in the form of liquid money, liquid and cheap money, because of the lockdown, the avenues were still restricted, right? When the avenues were restricted, where do they spend this extra liquid money which has actually now flooded their bank account? So what they decided was, the institutional investors, after the month of March and April, they started to prune the market, they started to pump the market because they were also flush with the money and the market started moving up. So this neo Robin Hooders, they started to directly participate in this market as well, because understand why it has happened. In normal circumstances, if there were no lockdowns, people would still explore the avenue of spending it on a car, spending it on a new house, spending it elsewhere, spending it on a vacation. But now the extra disposable income is only expended in either producing a new baby, uh, yeah, yeah, or actually betting in the market, right? So that's what happened, and the added liquidity in the market prompted the bourses across the world, whether it's the developed economies or the emerging ones or the frontier ones, at an astronomical valuation of what we are witnessing today. The Dow Jones skyrocketed 30K past for the first time. Nifty passed 15K for the first time. And the story is similar across any Europe, any geographic region that you can think of. All right? All right. Now, the next thing is that there is also a total corporate debt, which is overhanging at $10.9 trillion. All right. Now, let's talk about an emerging market like that of India. Traditionally, we had the Nifty P ratio. The P ratio for the uninitiated is basically the price to earning ratio. What it means is that for every dollar or every rupee the company earns, how much the market should price that particular company. So that's what the P ratio is all about. So traditionally, that P ratio is hovered somewhere around the mid-20s. And up till mid-20s, it's all right. Most of the greens that you would see is perhaps in their teens. But even at 20s, early 20s, mid-20s, things can be supported. All right. It's not an overheated zone. Remember those first couple of diagrams that I showed you? It's intricately tied to this. I'll prove it in a moment. Don't worry about it. Now, look at what has happened. Gradually, when you talk about 2020 and before 2020 itself, you'd see in 2019. In fact, let's take a step back and start from 2014 itself, when we had a new government coming in, which is now in its sixth year in India. Look at this from 2014, from 2015 onwards, it's all in pink. The P ratio is all mostly in pink, right? So what it means is that already our market was in the overvalued zone, okay? Overvalued zone. The pre-pandemic area, the pre-pandemic time was already, the asset prices were already in the bubble category, okay? So you see this 2020, so 2020 Jan, the P ratio was somewhere around 28. It hovered around 28, 21. And yes, of course, in the month of March, it came down to 20 because of the pandemic. It took some hit it took. But look at what has happened after August. After August, there is just no looking back. So in the last 6 months, we have now in a 41 at a P of 41. Now let's see what the doctor says. The doctor says, if you ever get your P ratios, if you ever get your P ratio in the 12 category, you should always buy, right? But if your P is between 20 and 30, in this mid-20s, you should book 80% of your asset prices. Beyond 30 and between 35, you should look at all the avenues to actually sell your assets. But what happens if it is more than 35? Any guesses? What do you say? All right, let's take a close look at what has happened to the Dow Jones as well. So in Dow Jones, the same P ratio, you can see the sweet spot of this P ratio is hovering around somewhere around this 20 mark, which is absolutely fine.
In 2008, at the Lehman Brothers crisis, at the height of the crisis, the P ratio had actually skyrocketed at 120. We all know what had happened. Now the P ratio is somewhere close to inching towards, it's inching towards 40. I would say it's around 37, 38. When was the last time it happened? It happened again in the dot-com bubble crash. So on a chart wise, economically speaking, we are actually in more or less in the same vicinity. Well, in the dot-com bubble crash, we were close to 45, mid 40s, close to the 50 P ratio max. So we saw what happened. The dot-com bubble crash happened, and by the early 2000s, we came back. The P ratio then came back to a stabilized level of 15, which is the sweet spot. And then the pandemic happened. The pandemic, before the pandemic also, the pandemic happened. The pandemic, we had the Nifty at 718, and now it is hovering on 37, 38. So do you believe that the Dow Jones is overheated? Now, I know that it has been a pretty long and pretty detailed exercise that we had done, but this was actually required for laying down the fundamental and the technical aspect of what has happened in our economy. Now that I'm not actually making it up for myself, so let me just now take you through the charts. So I have got a few of the charts that's open. Let me first talk about the Nifty 50 chart. All right. So this is the bare bone Nifty 50 chart in front of you. All right. Between 2003 and 2007, we had a fantastic bull run. Now let's see what is the trend angle. If you take the trend angle, it's around 25 degrees. All right. We had a superb bull run, and then the 2007, the crash started happening because of the Lehman crisis, the subprime crisis, and then we plummeted. And the economy actually was in reset mode in early 2008, and then thereafter there was some degree of stabilization before actually from 2009 onwards, it actually again started to go up. But after 2014, there was no looking back. And if you see this growth trajectory, the trend line is at around 16 degree. Okay, so we had 25 degree here, we have a 16 degree, and this we can say it's a long run because it's the last decade's run of Nifty from let's say a point of, let's say, 5,000 from 5,000 before the pandemic hit us. We were at 12,600. So we have practically grown 120% over a period of 10 years. So roughly you can say, just for a rough estimate, it's around 12% growth on a year-on-year basis. All right, that's what has happened. But once the pandemic hit us in the last 1 year, let's see how we have progressed. We have grown, and the trend angle is 69 degree. Is this sustainable? Well, I don't think so. It's sustainable. All right, I know you may not quite believe me, but let me now take off this trend angles and let me point something else. So I have discussed so far from the economics perspective. Now I'm discussing through what happens to the charts and the technical things. The theory versus the practice. So I'm going to take something called as the Bollinger Bands. All right. So I'm going to plot the Bollinger Bands, and I'm also going to that should be sufficient. Yeah. So the Bollinger Band, what it says. Let me tell you what the Bollinger Band is. The Bollinger Band consists of three things. One is the middle line, which is again very similar to the long run average. Remember, we showed you that particular line. So this is the Bollinger Bands, middle line, okay, which is the long run average. Now these two ends of the Bollinger Bands are these two extremes. What does these two extremes actually signify? All that it signifies is that whenever an asset prices actually breaches or actually touches these two extremes, it has an automatic tendency to come back nearer to the midline. So the midline almost acts like a magnet. All right. So to exemplify a little bit more, I will put in one more indicator to this, which is called the Keltner channel. It is a little bit more sophisticated than the Bollinger Band itself. And you could see the same thing. The midline almost roughly, it actually concludes coincides with that of the Bollinger Band. It's got a little narrow range, but the purpose is similar. So you can see in past also, so let me just highlight here. All right, so this point, this point, this point, this point, this point, all right? So see, every time it has touched the upper end, it has been pulled back sharply, right? Either on the plus side or on the minus side. Even if it's on the minus end and the extreme end, it's being pulled back sharply. Towards where? Towards the middle line.
right? So this is the property of the Bollinger Band. So if we go by that, you see we are already in the upper circuit, upper stretch of the Bollinger Band, which suggests that the next move of this Bollinger Band is not going to be on the upside. This is much as we could have gone up, and it's going to be pulled back to the middle line. So this is our Nifty 50 chart, bear chart. The Nifty Bank chart is pretty similar. I'm not going to draw it, but you can do it for yourself. Now let's take the Dow Jones chart. Well, Dow Jones is again a similar story. If you don't want to believe me, let me just do it. I'm not going to draw the angles, but the Bollinger Bands. So with the help of Bollinger Band, there you go. So you see that it's already past the extreme end on the upper side, which means that the only other way to go is down nearer to this middle line, pull back to this middle line. All right, great. What happens to the Nasdaq? Well, Nasdaq is same thing, right? Nasdaq is again same thing. All right, so all these three charts, what they suggest us is that if we are already in a volatile, not only in a volatile market, but we are already in a very highly overheated and overvalued zone. The eventuality of which is that it has to correct itself, if not actually precipitate into a full-scaled, full-bodied, full-blooded fall to the precipice. It at least has to correct itself. Let some steam go off, right? That should be pretty much evident. All right. Now, let's talk about the one more market, and that is something called as the Vietnamese market. Now, why I picked up this Vietnamese market? Because Vietnamese market is supposed to be in a frontier market. A frontier market is something which is not as advanced as that of the emerging market, let alone the developed ones, but it's much better than the poorer markets. All right. Now, an interesting viewpoint I wanted to draw your attention to. Let's see, May 2009, it's a month-on-month basis what the Vietnamese market has returned, their stock index, right? All right. So the VN30, which is the Vietnamese stock index, very similar to a Nifty 50. What it does is, let's see, April 2019, we had a minus 1.06% month-on-month basis. It returned minus 1.6 in May, and it kept on moving to July 2.19, 1.06, 3.4. March 2020, a negative of 27%, no surprises. And then again, we sprung back at 17%, 12%, right? So even if you discount these 3 months for obvious reasons, but still, if you look at June, July, you see the kind of volatility that it is presenting. In 1 month it's negative. The month after that, there is 12% plus. In 1 month it's 3%. Another it's 4%. Another month it's 8%. Immediately doubles, 100% jump. Right? So all that it talks about is that predicting such kind of markets and the other frontier markets, for example, Bangladesh, Sri Lanka, Kazakhstan, I could not even find the PE chart. I could not even find such a bit data. So such is the paucity of data that's there. Now what it signifies something called as volatility. Now this volatility is something of concern because it actually it actually takes away your forecasting power altogether, right? Great. So we talked about the Nifty, we talked about Dow Jones, Nasdaq, and we also touched based upon a frontier market. Now, what was the need for all this? Well, I'll come to that a little later. Before that, let me dive to something called as the dollar index. Now, what does this dollar index mean? All right. So this dollar index, all that it means is that how dollar is being valued. So you would be surprised how dollar is being valued. So far, you would have thought that, we are being valued against dollar. That means dollar would be valued against something. Or it may not be because it's an absolute currency. Well, it may be an absolute currency, but nonetheless, it's a fiat currency. What does a fiat currency mean? Fiat currency means that the government will need not store an asset, for example, like that of gold, in order to print money. So which means that the Fed may decide on a printing money spree, thereby inviting inflation, and give them fancy names like quantitative easing, and yet not to be accountable for it because they don't have a reference point, they don't have a benchmark. So it's like this. If I have, let's say, 1 quintal of gold stored in my bank, that gives me the power of printing as much money without devaluing the currency. Okay, so there's a benchmark. Every currency would have done so.
Till 1960s, the benchmark of gold was universal across the world. But after that, I don't know what happened. Most of the economists, or most of the sovereigns, they thought, well, gold is very difficult to value because it has so many varied applications. So let's not actually peg gold. Let's not actually peg our currency against gold. Instead, what we will do is that we will take out a basket of currencies. So which are those basket of currencies? There are 5 basket of currencies in varying proportion. Which are those basket of currencies? Okay, so the first is, let me just write. Yeah. So the first is euro, having, let's say, 60% weight. Second is the pound sterling, British pound, that is. Third is the Swiss franc. Next is the Swedish kroner. Yes. And last is the Canadian dollar. Okay. With varying proportion, with the highest being that of euro, followed by that of pound. All right. So pound is almost, I believe,